some of the valuation craziness that's starting to come back to earth, and a lot of people kind of having a bit of a tough time, particularly if they're tech investors or were invested in some of these high flying growth companies. And you kind of said, valuation still matters. It turns out. I was wondering if you could speak to that a little.
Yeah, I mean, for the listener, we talked a little bit about this beforehand. I'm going to, Tom, use a slightly different analogy. We can go back to what we talked about as well.
Sure.
But um, I'm not a good golf player. I don't play a lot of golf, but we all dream of getting, those of us who've played any golf at all, we all dream of getting onto the green, going to the, hitting a drive that goes straight down the fairway and hits the, lands on the green. We all dream of hitting those perfect golf shots. And golf is a strange game that even if you're not very good, as I'm certainly not, every now and then, even somebody who's not very good hits a shot that looks like Tiger Woods could have hit it. And it's like, my God, I'm a freaking genius. And that's what we live for. And it makes us feel great. But the real game of golf happens when I take a sod of earth and the golf ball goes straight into the trees and it's just horrible and I've lost a ball and all of those things. That's where the game of golf really begins, actually. So this great friend who's actually an investor who comes to the Berkshire meeting, Aaron Bird, you should interview him. He's a lovely guy. He kind of got me into golf. He was an intern of mine. And sorry, while I go on about him, he's the guy who connected me to Warren Buffett. He said golf is a game of adversity. It's a game of managing adversity. The real game of golf, the inner game of golf, is, yeah, every now and then you get a celebration when you feel like you're Tiger Woods, but most of the time it's managing that adversity that you get into. And so we can imagine, when I buy Raffles Education Corp, which I did I don't know how long ago, and it goes up 6x, that's like hitting that beautiful golf shot down the fairway. But that's not actually the game of investing. That's kind of like the icing on the cake. The game of investing is when you hit adversity, and we all hit adversity. So I think that the first thing that I would say to those people who are licking their wounds with some kind of either realized or hopefully unrealized losses in their portfolio is to realize that this is where the rubber hits the road. This is where things really get started. This is where you get the opportunity to prove your greatness. And to just reference, Marcus Aurelius says it so well. So forgive me if this is already well known to you. He's approached by one of his generals and he say, it's so difficult. The enemy's so strong. Our troops are so tired. Our weapons are not as great. The weather's bad. The conditions are bad. So I might have to go out and fight this battle for you. And Marcus Aurelius's response to the general, in one of his writings and meditations, he says, "Oh, yeah, I understand. You want to be virtuous. You want to have fortitude. You want to have courage, but you don't actually want to prove them on the battlefield. You just want to have those virtues. And life doesn't work that way. The way life works is that you actually have to prove those virtues in real life if you believe you have them. And so this is the opportunity to be heroic and to prove and discover the virtues that we have inside of us. And in a certain way, I think that it's sort of strange because we all have those virtues. So the virtues are ones of fortitude, patience, looking at reality in the eye, acknowledging our mistakes, making the best decisions today. And the key is that all we have to do is decide we want to have those virtues and then take those actions. And so the story that, for those listeners who are interested, that I told Tom, that I've told it privately, but haven't told it publicly in this kind of forum. So, and I'm really happy to do it, is the story of my experience with Laboratory Corporations of America. This all happened in the early 2000s. So there I was. I'd actually had the opportunity to shake hands with Lou Simpson, who was one of Warren Buffett's lieutenants, an extremely talented and capable investor who suddenly a new position appears in his portfolio, a company called Laboratory Corporation of America. And this was a merger between a company called Bioreference Labs, which was partly owned by Roche in Switzerland, and National Health Labs, which was an American company. And this was the future of blood lab testing was high capital expenditures, but many, many tests, which would be very expensive and only capable of being done by the largest, most capitalized labs. And so this was clearly going to be one of the winners in a consolidating industry. And there was potentially one competitor emerging, and they'd taken a certain amount of debt to do the merger, and there was years of endless growth ahead of them. And then they had what I remember as a technical default on their debt, and the share price rapidly dropped from $8 a share approximately, which is where I had bought it, to $2 a share. And so at that point, so far so good, because that is just the normal course of business in the stock market. Things happen. Things don't always turn out the way you expect them to. The last 5 or 6 years has been a very unusual period. And again, that's where the rubber hits the road. And for the benefit of the viewer, I made a number of really big mistakes, or a number of errors that I would prefer not to have made. So first of all, nothing other than a quotational loss. And you're talking about a 75% loss on my purchase, which is about what some people have in some of their SaaS tech businesses. And but nothing else had happened. Nobody was yelling, "You idiot!" Nobody was telling me to sell the shares. I don't know what would have happened when I reported to investors, if I would have gotten redemption requests or not. But at this point, none of that has happened. So a first mistake is that I went into a funk. All I could do was think about this company. I had other companies in my portfolio, but all I could do was think about this company and how much money I'd lost on a quotational loss. And in this case, the bankers were Credit Suisse, and they had a very close relationship with Roche. And they took a penalty from the company, and they modified the loan agreement. So it wasn't like the company was about to go into Chapter 11 or anything like that. It had a solid set of shareholders who were totally capable, if necessary, of recapitalizing the company, but that wasn't even necessary. They just needed a modification on one of the sort of covenants on the loan, as I remember. In any case, I couldn't think of anything else. And eventually the pressure came too great for me, and I sold the shares at $2 a share and felt so much better afterwards because the position was cleared out and I didn't have to think about it anymore. And that was that. And I tried to forget I ever owned it and tried to forget that I ever bought it. 5 or 6 years later, I discovered that Chieftain Capital Management owned shares of the company. I don't remember the name of the guy leading it, of kind of like buy and hold long-term investors. In any case, the results for the company were that it was more from the $2 a share, it ended up at more than 100 or 200x, perhaps even more. It's too painful for me to do the study. The most profound fact about that is that if all I had done was done nothing, if I just held on to my shares at $8 a share, I would have made a lot more than 20 times my original investment. 20 times. My original analysis was right. All I had to do was sit there and do nothing, and I failed to do that. So in retrospect, did I pay too much for the company? Perhaps at that particular moment. And I bought into the flush of excitement at the merger and the fact that Lou Simpson had bought a bunch of shares. And I bought in the midst of enthusiasm, but then I doubled down on that mistake by selling it at the wrong time. And so, I think that many investors right now are waking up to realize that they've made the mistake of overpaying. But I think that in many cases that I know of, they've actually bought into some extraordinary businesses. And what Charlie Munger says is that often the pain in the markets happen not because of a bad idea, but because of a good idea that was taken too far. And so many of these companies are extremely well managed. They have some super high quality people running them. They are not all of them, but some of them, and perhaps many of them, are extraordinarily good businesses. I believe that those people that I know who are invested in them have done good research, excellent research, beyond excellent research. And yes, perhaps they've paid too much for them, which is easy to see now. but it would be a great shame to compound that mistake by selling at the wrong time, if you like. And so that was a signal lesson to me, and perhaps that is helpful for some people who are sort of licking wounds right now. And the one other thing that I would share that doesn't originate from me, but this concept of freezing a position, of saying, you know what, this is extraordinarily painful for me. I can't believe it's gone down so much, but I'm aware that. So what I say for myself is, I understand now from my experience in Laboratory Corporation of America how I sold irrationally. But in the moment when I sold, I didn't believe I was being irrational. So um, the emotional brain is so powerful that it can convince the rational brain that the emotional brain will take over the rational brain and convince the rational brain that it's acting rationally when actually it's the emotional brain that's taken over the steering wheel. And one way to avoid that kind of mistake is to just say, when I'm feeling this extraordinary pain over a quotational loss, for example, I'm not going to allow any action, period. I'm just going to freeze it. I'm just going to do nothing. And that's just the way it's going to be. And it's fascinating to me how the people who seem to do the best in the markets are the people who do less. And so to find ways to convince ourselves to do less is a good thing. And this period there'll be a lot of people who stop talking about their portfolios, will quietly go out of business. But if those but I urge those of you who are listening who are determined to stick around, this is your opportunity not to shine necessarily, but to survive. And sometimes surviving is enough, and don't set too high standards for yourself. This is an extraordinary, difficult thing. And sometimes surviving is thriving. How did I do, Tom?
That was great. I appreciate you sharing that, Guy. I see a lot of people kind of, sharing your 13Fs and things, and referring to you as the master of doing nothing. I think maybe not quite rivaling Charlie, but you know, aspiring to that level. I think, and I can see that maybe those past experiences have kind of seared that in. I know you're an extensive user of checklists as well. Are those experiences you just described? Was that sort of the genesis for setting up investment checklists also?
Um, so one thing is that people are focused on the 13 Fs, but they're not aware of what I have outside of the
Sure.
US, which I'm quite happy not to share. I
Fair
don't have
enough.
to. And
Fair enough.
but for what it's worth, you probably, if you look in India, you'll see me showing up as a shareholder, at least in a couple of companies. But interesting enough, I haven't made any moves there either. So the portfolio has stayed pretty static through this period. I think that, I actually, a big change for me is that my letters can now be read by everyone. So you're welcome to go read those letters. And um, I think that, I'm almost hesitant. It's not that I'm hesitant. This is kind of like the big secret for me, or a big secret that's been revealed to me recently, is that William Green, in talking about Nick Sleep, talk in Richer, Wiser, Happier, talks about destination analysis. Uh, Look at where you want to end up and then rewind from there. And I think that there are so many businesses that I've watched friends of mine own where I just say, I can't see the destination. It looks really sexy right now, but what's the destination? And if the destination is not somewhere that I want to be, then then uh, I'm not going to invest in it. And I just have to take a mating analogy, human mating analogy. So, if I don't know, are you single, Tom?
No,
You're not single. Are you married? You
no,
married?
I'm not
No?
married.
Okay, partnered up. So, but the thing is that I experienced when I was way younger, maybe many of us have experienced the thing of the one night stand, or the drunken night in a bar, and then there's a kind of the wolf syndrome where you want to bite your arm off because you find your arm off somebody underneath somebody that you really don't want to be around the next morning. That is an example of not engaging in destination analysis. An example of engaging in destination analysis is to only hang out and certainly only go home with people you'd want to spend the rest of your life with, because then the destination is a positive destination. You never ever in investing want to wake up and discover that the thing that you thought you were getting married to really ought to have been a one night stand. And so every single company, and I've done this with companies where people say this is a spectacular business and they're making so much money and they're not that expensive. And my answer to them is yes, but I don't know where the end point is. I don't know where they end up, and I want to know where they end up. And every single company in your portfolio is one where I can see my way to an endpoint that is a good and positive endpoint that I want to be in, then that's something that you want to own for life. That's something you want to be married to. And so people in this period are waking up to, to use the analogy that they took home somebody as a partner, and then they're waking up the next day and it ain't looking so good anymore, and they want to chew their arm off. And what you really want to do is make sure that whatever company you take home with you to get is one that you actually want to get married to. And every single company that's in my portfolio, I want to be married to that company effectively. And so why would I change? And it's actually, the letter was really, really well timed, because I talked about going into inflation and higher interest rates in a time of extraordinary uncertainty. And I asked myself, and I asked the reader, where do you want to be as you go through this period? And the answer, and I reasoned through to an answer which basically says, you want to be in these businesses. And, maybe there's a selection of the businesses that you want to, this is where you want to be. And, just very briefly, I used the analogy of, if we just imagine all stock investing is real estate, if you already own the best real estate in town, you own the best office building, you own the best McDonald's franchise, you own the best shopping mall right down there next to Trump Tower, let's say, and the storm is coming, whatever it is, do you really want to go and buy warehouses on the edge of town? Do you really want to sell your real estate and buy and hold cash or anything else? Or do you want to continue to own? Sorry, there's something in my throat. Hopefully that takes care of it. Or do you want to own the best assets you can possibly find? And my answer is to own the best assets I can possibly find. And so that's why there's zero portfolio turnover. In terms of checklists, I don't think that the checklists have helped me to lower my portfolio turnover. I think it's really this concept of destination analysis, knowing where you want to end up and not doing anything that is inconsistent with that outcome, which basically means that 98% of possible actions in the stock market are ones that you end up not taking for that reason. I'll give you one example that, and I hope I'm not pouring fuel on a burning fire, but if I was a trader type, what I'd really like to do right now is short tether, because I think that in the crypto world, and I know I've just made a whole bunch of crypto enemies right there. But the destination, there's no conceivable good destination from that. So I'm not going to do it for all sorts of reasons. But there are many examples of that. I was uh, I was looking at a company called Basic Fit. Basic Fit appears to be a phenomenal business. They run low cost gyms in Europe, and it's really well managed, and it's a good business. It generates a lot of free cash, and it's got scale economies, and they're going good places. And the valuation was suppressed because all sorts of growth aspects of the growth of the business were heavily dampened by COVID and lockdowns. But I don't know where that business ends up. I don't know what happens to health clubs in 20, 30 years. Maybe we're all working out at home. I have no idea. So it's just a no-go for me, even though I'm probably going to leave, at least for a 5 or 6 or 10-year period, a lot of money on the table. And I think that something that really, this is another one of the reasons why we go to the Berkshire Hathaway meeting. So during the financial crisis 10 years ago, I discovered that Berkshire Hathaway had loaned money to Harley Davidson. And Harley Davidson was a brand that I really like. It's an iconic brand. There's this wonderful statement that if any brand that gets tattooed into people's arms is something that you want to own. I mean, that's kind of pretty amazing. And then it was just phenomenal for me because the shareholders one of the shareholders asked the question. They asked to Warren, and Charlie, we saw that you had bought some kind of debt issuance of Harley Davidson. Did you consider buying the equity? And I kind of at the time would have thought that Harley Davidson would be the kind of brand that Berkshire Hathaway would love to buy. And Warren said something along the lines of, we're not so sure where the brand ends up, but we felt pretty confident that the debt was well covered and safe, and it was offering a nice rate of interest. And so I think that Warren, again, there's no lesson that I've learned that I don't realize that Warren hasn't already learned it. And I think that he was engaging in a kind of destination analysis. And it's not enough for Warren to say, to enjoy the idea that it's tattooed into people's arms and it's a well-known brand. No, he really thinks through to saying, is this something that will be around after the flood, after the apocalypse? And I think that his conclusion was no, but the secured debt was something that was okay to invest in, but the equity was not. And so one should have extraordinarily high standards about that destination. Now, the reason why I was hesitant is that I don't want everybody to think that way, because that will take away opportunities for me. But we have to be open, and we have to teach, and we have to be generous. So I'm doing it for that reason. And I realized that half of the, something I learned from Monish, you can give your secret sauce away and people still won't implement it in their own lives. So, and the world is big, but yeah, so that's really the reason why there's zero turnover. I like what I own, other than well, I sold Twitter, which was,
Yeah.
and I worry about saying that, and I already said it on Twitter, because I don't want to start justifying every portfolio move in a podcast or elsewhere. But
Yeah.
but and for what it's worth, I'm feeling unbelievably smart because I feel like I called it right. And the bottom line was what I said was, I said, so the story of my Twitter investment was that at the very beginning of lockdown, when I saw these businesses valuations go through the roof, so lockdown kind of accelerated a whole bunch of businesses that we know: Netflix, Peloton, Zoom. And I kind of had not owned any of these new economy businesses. And I understood that they were good businesses, and I didn't like the valuations. And I just said to myself at the beginning, around the beginning of lockdown, you have to at least own some of this to understand what it feels like to own it. And so one of the companies I bought, or the only company I bought, was Twitter. And the reason why I bought it, I'd never paid such a high valuation. I was paying, I believe, about 10 times revenues. I'd never paid such a high valuation for a company. And I kind of, my kind of like desire is more like 50% of revenues or less,
Yeah.
something like that. At the point at
Those
which
were
I
the
bought
Fiat
Spier.
Chrysler days. Yeah,
Yeah,
exactly.
exactly. That's more my style. But I said, hey, you got all done, and sometimes it's not enough just to watch. So why don't you just put some money into this and see what it looks like? And what I said to myself about Twitter was that I could see and understand how influential the platform was, even if that wasn't translating into cash flows. And uh, I believed, as I guess Elon Musk believed, that there were things that you could do with the platform to really make it shine. And so I bought it, and I round tripped the share price. So the share price doubled. Didn't pay a lot of attention to it. So at that point, it was more or less 20 times revenues. And then it went back to around my purchase price. Then Elon Musk made the offer to buy it. And what really shocked me, I love the fact that Elon Musk was making the offer to buy it, because I felt like his analysis coincided with mine. But what shocked me was that the company was so quick to say yes and to sign an agreement with him, which led me to believe that they were actually out of ideas and they were out of potential buyers. It really surprised me that, when LinkedIn was available for sale, if my memory serves me right, Salesforce and Microsoft were both very interested in the company, and it would have been an extraordinary acquisition for Salesforce had they bought it. Microsoft ended up getting it, and if it hadn't been Salesforce and Microsoft, there are at least a few other businesses that would have been very happy, I think, to bid on it and to own it. Maybe IBM, maybe Oracle, and perhaps others that I'm not even thinking of. And so people who know way more than me did not want to bid on Twitter. Facebook didn't want to bid on Twitter. LinkedIn or Microsoft didn't want to bid on Twitter. What's going on there? Why? And so I realized that if the Elon Musk bid fell through, which I thought was very likely because I think Elon Musk is utter genius, a gift to humanity, but also highly erratic, then they'd be at the dance with they'd have nobody to take them to the dance. In a certain way, they'd have no clothes on because the fact that there was no competition on Elon Musk's bid revealed that there's some serious issues with the business that restrained the Microsofts and the Salesforces and the others, the Facebooks of the world, from wanting to bid on them. And so, it's one of the few times when I kind of said the people are enthusiastic. Now's the time to set into that enthusiasm, and I actually got it right. And so I'm patting myself on the back a little bit because that's a bit of a, every now and then, if you spend enough time on the golf course and you keep whacking, you'll take up a lot of sods of earth, but every now and then you'll actually hit a good ball. So I'm feeling good about it.